All right, is my sound back now? Hopefully my sound's back. All right, good deal. Okay, so the first thing we're going to talk about today is Paycheck Protection Program. Kind of an update on that. Some new information has been released in the last couple of weeks, and also minimizing our taxes as things are going. So here we go. So many of our clients now have received information that they have either have received their PPP money or it's going to be on the way shortly here. Many questions I've gotten are, okay, so when does the money start coming? Or I'm sorry, when do we need to start spending the money? So we need to start spending the money, or the clock starts ticking when the bank disperses the money, the funds to us. So that's when the 8-week period starts. Something that's interesting to note, maybe not interesting, but if your loan was calculated on 10 weeks of payroll, and what you actually have are 8 weeks to spend the money on payroll, rent, utilities, etc. So I've talked about this many times, but we need to spend 75% or more of the money on payroll-related expenses, and we can spend up to 25% on rent, mortgage interest, and utilities on contracts that were in place prior to February 15th. And the next question that comes up is, well, who's going to monitor the forgiveness? The forgiveness is primarily going to be monitored by the bank. So at the end of this, and I know the banks are still working on this, I've talked to several bankers, they're going to be, we as borrowers, you're going to be required to submit information to the bank that proves you spent the money where you were required to spend the money. A couple of clarifying questions that have come out in the last couple of weeks. So will the borrower's PPP forgiveness amount be reduced if you laid off an employee, offered to rehire the same employee, but the employee declined to offer? So what's interesting on that is we've had clients call us and say, hey, we have people in the warehouse that don't want to come back to work because they're making more money on unemployment with the extra $600 a week than they would be if they were back here at work. So what the SBA Department of Treasury has come back out and said is that if the employee does not come back, your loan forgiveness will not be reduced. As long as you have offered them employment, you have documented and signed that the employee declined, that they signed that they are declining. And then this is where it gets a little bit more interesting, is that for employees that take that option, that they'd rather stay on unemployment, that they may be forfeiting their eligibility for continued unemployment. So again, I think what's happened here is the government has shifted the responsibility onto employers to make sure that employees are employed. And now we're shifting that responsibility. If they're deciding not to come back, we're shifting that responsibility to the employee, which is, I believe, is the way it should be. Next is, will the SBA review individual PPP loan files? The answer to that is yes, if the amount was over $2 million. There's been a lot of noise in the marketplace about companies who took the money that didn't need the money. And as a result, the Department of Treasury is going to look at this deeper. The SBA is going to look at this deeper and make sure that the companies that received it were actually eligible to receive the money. So you still have there were still standards established in the loan application process that anyone who applied for the loans stated that they needed the money. So that is still going to hold. And then looks like the SBA is going to be looking further at loans over $2 million. And then for any loans where, and I believe this is where it's going to be loans that maybe there was whistleblowers or something. They are going to look further at loans that they believe they should look at. Not quite sure how that's going to happen. I think one of the things that we need to keep in mind here is that in the first 14 days of the PPP program, the SBA or the banks, for that matter, loaned or provided more loans in 14 days than they normally do in 14 years. So you also have to think of how are they going to monitor this and who's going to monitor this. A couple of recommendations that we have, document now in your corporate minutes. So whether that's working with your attorney, whether you do your minutes on your own, what have you, document in your corporate minutes now that when you applied for the loan, when you submitted the application, there was uncertainty in the marketplace. You did not know if you expected you would need it, and you applied in good faith. And you need to paper your file so that it's this way. Also, our recommendation is you create a tracking spreadsheet starting when you get the money and start listing the expenses you're paying for as you go. And that's going to help you when you have to submit information back to the bank for the loan forgiveness. Now, here is some new information that I believe we find quite interesting. I think most of us are going to find it quite interesting. The IRS issued Notice 2020-32 on April 30th. What we know about this now is income from the PPP loan forgiveness is not taxable. So if you received a PPP loan and the money is forgiven, so you spent the money where you were supposed to spend the money, that amount is going to be forgiven from an income standpoint. Internal Revenue Code Section 162 provides for necessary and ordinary business expenses to be paid. So covered rent, covered utility payments, and payroll costs. So covered means those expenses that we are paying as part of, the covered meaning covered under the PPP program. They are all deductible under Section 162. However, the IRS is looking at Section 265, which states that expenses related to tax-exempt income are not deductible. The IRS is only taking this position for the amounts forgiven and not the amount of the PPP loan proceeds. So what does that mean? That means that the loan amount that's forgiven is not taxable, but at the same time, the expenses that we paid with that forgiven loan amount is not a tax deduction. The bottom line, or in effect, that becomes taxable income. I know this was not the intention of how people understood this. I believe this was not the intention of how the program was set up, but this is the current information that we have from the IRS as of today. I know that the AICPA is going back and lobbying for this to be clarified. Hopefully that means changed. But anyway, this is new information that, from my perspective, makes this something that as business owners, we need to look at a little bit deeper and understand the tax impact of us doing this. I'm going to check here, see if we have any questions. Don't see any questions. All right. So the next thing that I want to get into is minimizing taxes. And I believe tax reduction, tax minimization is something that we need to do on a proactive basis. Quite often, I get information from information from clients that let's do this last minute, let's push this until the fourth quarter, et cetera. And I really believe right now we have the option of doing some true proactive tax planning. Okay, I do have a question that's coming in right now. What if the employer refuses to sign the document saying they do not want to return from unemployment? I don't have an answer for that. The information that I received was in the frequently asked questions from the on the Department of Treasury website, and that was the information that they provided, was exactly what I showed on the screen there. So I'm not sure what we do if the employee says that they do not want to return from unemployment. I do believe that you need to have your file documented, and if you have your file documented, maybe if they have an email that they're saying they aren't going to sign it, that might be enough to document your file. I think that's going to be a case-by-case basis. So oftentimes we think that we are minimizing income taxes, but we need to understand that we are subject to all of these taxes, right? We're subject to federal income taxes in the form of ordinary income tax, capital gains tax. Ordinary income taxes would be wages, income from our pass-through businesses, rental income, any stocks, bonds, et cetera, that we hold less than 1 year. Capital gains tax are taxes that we pay typically at a lower rate on items that we've invested in and held more than 12 months. So we're subject to those two taxes at the federal level. We're subject to state income taxes, franchise taxes. So I know many of our clients are S corporations, and you paid a 1.5% tax to the state of California on an annual basis. That 1.5% is not an income tax, it's actually a franchise tax. We pay unemployment taxes on our own wages, on our own income. We also pay employment taxes on our employees' income, property taxes, sales tax, and then estate tax. And estate tax for me is can be one of the bigger areas and more expensive areas that people don't think through until they have to think through it. So what we found is that we can layer tax strategies together and have, sometimes significant savings. But that takes time, and that takes a deeper understanding of a client in all of their situations. So not just here's our P&L, tell us what we can do to reduce the taxes. It's a more cohesive and deeper comprehensive process where we need to look at every single thing that the client has going on, and then layering in tax strategies. And again, for us, tax planning is a proactive process, not a just end of the year type thing. We're also in a situation right now where net operating losses, the tax rules around net operating losses have changed, and we have the ability to go back and retrieve refunds for the past 5 years. So maybe a good thing to do to see how we can create losses. If we're going to have losses in the current year, how can we increase those losses? If it's going to be ugly, let's let it be ugly, and then carry those losses back to get refunds. And I think I've talked a little bit about that. So I've got 3 case studies to go through here with everyone. The first case study was a manufacturing company who is consistently profitable, and they produce products to their customer specifications. So their customers tell them, this is what we need made, and they go figure out how to make it. What we were able to take out of that conversation and help the client with is they actually qualified for a research and development tax credit, which offsets current income taxes. The result, as we got into this, was we were able to offset current taxes. So on their current tax return, we were able to offset 100% of the California taxes and 100% of the federal taxes related to the income from that company. It also created a carryover to future years that we could continue to use. In the second year, we took another R&D credit study. We did another R&D credit study, which again increased that bucket of credits that they couldn't use. And you say, okay, well, why would we do that? Why would we continue to create credits if we can't use it? And here's the interesting thing for this client is we were able to bank credits and let those credits stack up. And 3 to 5 years down the road, when the client is out getting ready to sell his business, we're going to be able to offset hundreds of thousands of dollars of tax because he has built up this bank of credits that he wasn't been able to use in the current years, but he gets to carry that over until he can use it. So, this is a situation where we took literally one strategy, and it was able to offset taxes as well as income taxes in the current space, as well as taxes down the road when they sold the business. So here's another example of a client that we've been working with, that they built. They own several buildings. One is an apartment complex that they built for about $8 million. And typically you would take a residential property, and depreciation on residential property is close to 30 years on the tax side. So there's not much you can accelerate there. We actually did a cost segregation study. So took the components of the building and put those into components that were depreciated over faster time horizons. And we were able to create a $700,000 tax deduction in the current tax year, which saved $280,000 in tax. So you think, wow, that's a really good result. Here's what else it did. That $700,000 tax deduction also created a net operating loss that we could carry back to previous years and get a refund. So there's benefit number 2. And benefit number 3 was we had accelerated tax deductions for the next 4 years as well. So we were able to do some really good things, again, with one strategy that went over multiple horizons. The last case study is a business owner that we had just started working with, looking to sell a controlling interest in the business to their son and also a key employee. So both a son and a key employee, so 2 people. Whoops. So we reviewed prior year tax returns, looked at the current profit and loss, and we looked at the client's estate planning for opportunities. What we found was, again, another company qualified for an R&D tax credit. Their books did not properly state their inventory, so their internal accounting was not in good shape. And the owner had not updated his estate plan in years, and it was out of date, in addition to the fact that he had a taxable estate. So what did we do? R&D credit study to go produce refunds for the current year and previous 3 years. So we were able to go back and get refunds for previous years that were not, that they had not applied for. We corrected inventory accounting, and that also created a net operating loss, which we could carry back and get refunds. And then we put a gifting structure in place for his son, where we were able to transfer stock to his son and get that stock out of his estate, which saved over $2 million in estate taxes down the road. So again, this is a layering of strategies and understanding what's going on in the business. When we have the time to take a comprehensive look at what's going on, we can quite often find several areas where we can help. So again, I think we're in a situation today where we have changes in the current year, tax changes and changes in the marketplace that are going to allow for us to take a more comprehensive approach on the tax planning and create tax assets for the future, and probably create tax assets to maybe go back and get money back from previous years. So these are 3 case studies of things that we've been working on in different forms, and how we're helping clients. And I thought this would be relevant. I know some of the people on our call here today have some pieces of this going on, other pieces. So anyway, I just wanted to share that with you. There are ways to do this and save typically a fair amount of taxes. So I know that was short for today. If anyone has things that they would like us to cover, would like us to look at for the next 2 weeks, please let us know. Hopefully we have more updates on the PPP and on the taxability of those monies. And let me see if I have any questions here. Doesn't look like we have any questions. So at that, I'm going to go ahead and keep it short and keep it concise today. If you guys have any questions, please let us or anyone on our team know, and we will get things answered for you. Hope you all have a great day and a great week.